Good afternoon, everyone, and welcome to today's webinar hosted by Region 8 chapters of HFMA. The topic for today's webinar is Revenue Recognition Changes for Healthcare Entities. I would like to welcome today's guest presenter, Renee Gravelin. Renee has more than 29 years of accounting experience in the healthcare industry, with more than 26 years supervising healthcare audits. She is a member of Eide Bailey's Healthcare Technical Issues Committee. Renee has significant experience with health systems and critical access hospitals, accounting and auditing issues, and is a reviewer for healthcare organizations' single audits and uniform guidance audits. In addition, she is a member of the AICPA's Healthcare Expert Panel. So without further delay, I'll hand the call over to today's presenter. Renee, please go ahead.
All right, thank you, Nikki. We will be talking about revenue recognition, and I know the standard has been out for a couple of years now. The original standard came out in 2014, so it's been talked about. There was a delay, so I think it's kind of in the back of everyone's mind, and unfortunately the implementation date is coming up, so we're going to have to bring it to the forefront for the first round of adopters. Really, that would be in 2019. And you would need some comparative information. So 2018, which we're currently in, really becomes a key time frame for this. If you think about your financial statements, revenue is a very important number to the users of financial statements in assessing an entity's performance and position. It's really where the financial statement of operations starts. And because of that, there was a lot of discussion at the Financial Accounting Standards Board, the International Accounting Standards Board. Right now, the Government Accounting Standards Board actually has just recently, in the last week or so, issued their draft of revenue and expense recognition. So it's been a pretty big hot topic within the accounting geeks, if you will, talking about it. It came out as Accounting Standards Update, or ASU 2014-09. So as I said, it's been out since 2014. There was an Accounting Standards Update that delayed the effective date. Simply, it's a very large standard. If you've tried to print it out, it's probably about 500 pages. And it was becoming a little more problematic, especially for certain industries, including the healthcare industry, on how to adopt. Sometimes it's referred to as Topic 606. So if you actually go to the Accounting Standards Codification out on the AICPA's website or FASB's website or wherever, if you search Topic 606, that's revenue recognition. That's where you'll find it. So as I said, this has been discussed for a number of years, and as we've kind of converged or started to converge a little more with the International Accounting Standards Board, a lot of discussion, a lot of discrepancies between how revenue is recognized in the United States compared to internationally for certain transactions. Plus, U.S. GAAP, Generally Accepted Accounting Principles, had many revenue recognition concepts in various locations in the guidance. There wasn't a central location for that revenue recognition. And sometimes, unfortunately, that guidance actually contradicted each other. And so depending on kind of which set of rules that you followed or found within the guidance, you may actually account for the same transaction or very similar transactions differently. So the benefit of the standard is really to remove some of those inconsistencies in the existing guidance and provide a better framework, keeping in mind, if you've listened to any accounting updates in the last couple of years, one of the things the Financial Accounting Standards Board has been doing is going to much more principles-based accounting standards rather than rules-based. And that's what this framework, I think part of the reason it's such a long standard. Also improve the comparability, especially as I noted just previously, where an economically similar transaction could be accounted for differently. So trying to remove some of that, the problems with that. Provide more useful information to the users, so when it's more consistent, more transparent, there are additional disclosures required with this Topic 606 information. And then it says to simplify the preparation of the financial statements, I would say, for the next couple of years. I don't know that we'll believe the simplify. Hopefully that'll come once we get used to the standards. So as I said, there is an ASU that delayed the effective date of this, and part of that is certain industries, construction companies, a couple of other industries, healthcare being one of them, that the adoption of this standard became so problematic. And we'll go through, most of the presentation is going to talk about the areas where revenue recognition in healthcare organizations is complicated and made more difficult a little by the new standards that are out there. So one of the things, for example, there is a revenue recognition task force. There's multiple subgroups of that. There is a healthcare revenue recognition task force that has been developing what's known as white papers, and there is a reference to where you can locate those. And I think there's like 10 or 11 of these that really go through what certain concepts that we'll be going through, expands quite a bit on what those topics are, to give maybe more background, more in-depth discussion on what that really means for a healthcare entity. So that revenue recognition task force has been quite busy. So this will affect healthcare organizations, and as I said, I think it's just been out there for so many years now that people may have started to become a little more complacent, thinking it's going to happen, but we still have time. Unfortunately, I think the time has come. So the basic overview is that, and it looks like, you know, it's a 4-line sentence here, shouldn't be that difficult, but there's a couple of key concepts in here. So an entity should recognize revenue to depict the transfer of promised goods or services, really no change there, to customers in an amount that reflects the consideration to which the entity expects to be entitled. And that's really where kind of, if you will, the rub comes in the healthcare industry, and we'll talk about that in just a moment. So to kind of boil down the 500 pages or so of this revenue recognition standard, there's a 5-step process for determining revenue. You have to identify the contract or maybe multiple contracts with a customer, identify the performance obligations, and we'll go through what that means in the contract, determine the transaction price, and then allocate that transaction price to the performance obligations in a contract. A contract may have more than one performance obligation, so you'd have to determine if, you know, how much of the transaction price goes to each of those performance obligations, because you recognize revenue when or as an entity satisfies a performance obligation. So if there's multiple performance obligations, you would only recognize that pro rata share of the revenue for each performance obligation as it is completed. In the healthcare industry, really in this 5-step process, we're going to spend kind of the most time talking about steps 1 and 3, with 3 being quite a bit of the discussion. So going on, a little bit confusing, there's a 5-step process, and then later we're going to have 5 criteria. They're 2 different things. So one's a step, one's a criteria. Just kind of keep that in the back of your mind. So what is a contract? A contract is defined as an agreement between 2 or more parties that creates enforceable rights and obligations. So if we remember back to those of us who had to take business law, this is basically the definition of a contract. But also remembering back to business law, contracts can be written, oral, or even somewhat implied. And somewhat in the healthcare industry, there's certain situations where that contract, at least initially, becomes an implied contract. So now this, again, we have the 5-step process for revenue recognition, and now step 1 of that was the contract with the customer. Within the contract with the customer, there's 5 criteria related to what the contract should include. So these are the contract criteria we're going to go through. So we have approval and commitment of the parties, identification of the rights of the parties, and if you think to healthcare, this is really, you know, the parties would be the patient, and the healthcare provider. The identification of the rights of the parties would be receiving or providing healthcare services, identification of the payment terms, and we'll talk about that in just a moment. The contract has a commercial substance, so basically it's not a donation or something like that. Number 5 of this criteria is really where some of the problem comes in within the healthcare industry in adopting the guidance contained in Topic 606. It is probable, and the term probable is defined in the accounting guidance as something that is more likely than not, and also, and maybe even a little higher than that, it's not possible or remote would be kind of the other two definitions that are used. So it is probable that the entity will collect the consideration to which it will be entitled. So that the reason that one's bolded in a different color, it's a key concept within this 5 criteria. So we'll talk mostly about criteria 1 and 5. So 1, the approval and commitment of the parties, keeping in mind it can be written, it can be oral, or as I said, implied, in accordance with other customary business practices. So if you think about it, it's relatively easy to get written or oral approval for routine or elective type services. You get that as the patient comes in, they're conscious, mobile, talking, or a family member, if it's a child or someone who can't make those decisions, you're getting that information. For some urgent or emergent services, written or oral approval can still be obtained from a patient or family member, but not all the time. So basically it comes down to how is approval obtained when a patient is brought into the emergency department alone and unresponsive. Obviously you have to give care to the patient even if that consent is not received. But this is where that implied or other customary business practices would say that a contract does exist in this situation. If someone is in a, an automobile accident or, has some sort of cardiac episode or something like that and is brought to the hospital, the expectation of that person is, I'm going to be brought to a hospital and I'm going to receive care. So that's where the other customary business practice comes. So we're able in the healthcare industry to meet criteria 1 even without that oral or written consent. This kind of goes a little bit to both 1 and 3 in the criteria. Who are the parties of the contract? And this was discussed quite a bit because of the third-party payer nature within the healthcare industry, which is somewhat unique to the healthcare industry. Is the contract with the patient or is the contract with the third-party payer? And the conclusion is that the contract is between the healthcare entity and the patient. Any third-party payer is simply a vehicle for payment and they're not a party to the contract for the provision of healthcare services. There's a separate and distinct contract between the healthcare entity and the third-party payer as a payment mechanism. So the contract in this case, when we're thinking about it, is between the healthcare entity and the patient. So criteria 5, again, this really becomes kind of the rub, if you will, within this guidance for healthcare organizations. If you think about it, if you go into Target, I was there last night, I purchased goods, I get to the cash register, they tell me how much it is, actually it was under $100, so that was kind of exciting for me. But I can't negotiate a price that I'm going to pay or just say I'm not going to pay for this part, but I'm still going to take it. So Target reasonably has an expectation that I'm going to pay the $82 or whatever it was when I checked out last night. That's not how it happens in the healthcare arena. So concerns with this criteria come down to self-pay or uninsured or maybe underinsured patients, even thinking now of some of the high deductible health plans that are out there. Do you have a reasonable expectation of receiving and collecting that, $5,000, $10,000, whatever it happens to be? Denied claims present a problem, or pending Medicaid. How do you determine, is this someone going to qualify for Medicaid, or are they going to become private pay? If they're private pay, what can we expect to collect, that type of thing. So it becomes difficult to meet that step 5 criteria, and if you don't meet that step 5 criteria, you do not record revenue. So what ends up happening is kind of similar to how charity care is currently reported. If you think about your financial statement, that top line net or revenue, gross revenue, doesn't include any amounts that were charity care because you had no expectation of collecting or receiving any compensation for that. So that's similar to what happens in the case of, for example, let's use a self-pay patient where you really have not a reasonable expectation of payment. So what you're going to end up doing is having an implicit price concession for that. And we're going to go through some examples here. This was contemplated within the actual guidance of Topic 606 because one of the examples given in that guidance, and I have the reference there if you go out to a FASB website or something to get the accounting standards codification, you will find the example actually discussed in there, because this is something that the Financial Accounting Standards Board had contemplated as being a potential issue with the revenue recognition standard. So now what we're going to do is go through 3 examples. These are very high level, very simplistic, and one of the things I'll be giving some kind of insights. I have several clients that are currently going through kind of a mock run because they're part of the group that needs to adopt in 2019, making sure they have the information they need to adopt the standard, and have ran into maybe what we'd consider kind of some unexpected difficulties in just getting the debits and credits to work on the entry. So we'll be talking about those. So unfortunately, these examples are a little more high level, but I think they help to illustrate the concepts within the standard itself. So example 1, for those of you that are hospitals, patient presents to the emergency department and care is provided. Once the patient is stabilized, patient demographic and other relevant information such as insurance, that type of thing, is obtained. You find out this patient is uninsured and not eligible for Medicaid or charity care. And I know that's really easy to type up, more difficult to determine, but again, for the purposes of this example, we're going to make this assumption. Let's assume further that the standard fee for the services provided in the emergency department is $10,000. So what you need to know is, based on historical information, you know that the collection percentage for an uninsured patient with standard charges of $10,000 or more is approximately 10%. And we'll talk about what this concept is referred to, which is a portfolio type methodology. And so based on that, what happens within the guidance? So the solution. Revenue of only 1,000 would be recorded, which is the 10,000 multiplied by that collection percentage of similar patients of 10%. So some key points. As a practical application of this, likely your revenue would still be recorded at $10,000, and then you would have an implicit price concession contra revenue account for the 9. More than likely, you're not going to be doing this entry or these on a contract by contract basis. You're going to be summarizing the information, especially within your self-pay or higher deductible health plan portion, on a monthly basis, similar to what you do currently with your contractual adjustment entry. If you think about it, when we went through that example on the previous slide, the individual patient's ability and intention to pay, so that individual patient's credit risk, other than you knew they were self-pay and that they were not eligible for charity care, is not taken into account at this point. It's just based on, here is this portfolio. We know patients that are uninsured and self-pay, no charity care, will only pay, based on our historical information out of our revenue cycle, about 10%. Keeping also in mind that under the new guidance, the provision for bad debts moves back to an operating expense. And for those of us, as Nikki had indicated, I've been in the healthcare industry for 29 years, that operating or the bad debt provision has moved between a deduction from revenue to an operating expense, back to a deduction from revenue, and now going back to an operating expense. And part of that reason will become apparent because that implicit price concession of $9,000 is a contra revenue. So now we're only talking the $1,000, that if you don't collect that, that part is really the bad debt. Part of, or potentially bad debt, you may have an adjustment to your revenue recognition as well. However, if you think about it, as an organization, you're going to try to collect the entire $10,000 of this. So for purposes of your financial statements, you've only recorded $1,000 of net revenue, but when this account would be, say, in 6, 9, 12 months, whatever your policy is turned over to collections because this individual did not pay, that entire $10,000 is turned over to collection. So there has to be a tracking mechanism so that you would have known, you know what, when we estimated this account would only be, 10%, so all we recorded was $1,000 of net revenue. We've already recognized that $9,000 of the implicit price concession. So if that entire amount is turned over to collection, only $1,000 would go to bad debt. And so this is one of those, as the clients we've been working with that have been kind of mock practicing this had been something that really hadn't been thought about on how that type of entry is going to need to be developed so that we have the right amounts being recorded. So going on to example 2, it's the exact same as example 1, other than this patient is insured by commercial insurer A, which has a $1,000 deductible and 20% copayment, same standard fees. Again, based on historical information, and we're going to need this information pulled out of the billing and collection system. Probably will need to be working with your business office, I should say, experience with the business office individuals. They know a lot of information and need to be asked what they think. However, sometimes there's a bit of a disconnect. They think of it differently and look at it differently than what accounting looks at it. So it's trying to come up with that common ground so everybody's speaking the same language to try to come up with this. So based on this, you would know that there's a reasonable expectation of payment from commercial insurer A. There's going to be the contractual adjustments based on the contract with commercial insurer A. And then also based on that historical information, you as an organization know that the patients with commercial insurer A will pay substantially all deductibles and coinsurance amounts. There really isn't a lot of amounts written off. So if you think about that one, that's going to be very similar to what you recognize as revenue right now. You have a reasonable expectation of payment other than that contractual adjustment arrangement. So you'd record your revenue and then your contractual adjustment based on the contract you have with commercial insurer A. So again, key point, very same as the pre-ASU 2014-09 or Topic 606 recording. If the patient ultimately, in this case, would not pay applicable deductibles and coinsurances are part of that, again, this would be recorded as bad debt expense, as an operating expense, or if it's a couple of months down the road and you're reevaluating commercial insurer A, realizing that, you know, we used to collect 100%, now we're only really collecting 80%, you know, maybe that 20% shouldn't have been recognized as revenue in the first place. So it's a never-ending process too. You have to continually update things. Example 3, and this one gets a little more complicated, but it's just to demonstrate a point. In certain areas, I was just at a facility in California, and they do have kind of a one-time, you can identify someone as Medicaid before they go through the process, and Medicaid will kind of pay it. I'm simplifying that. But there's a lot of times where you're going to have this bucket of pending Medicaid, people who are going through the process of trying to become eligible for Medicaid benefits, and sometimes that can take a while. So again, same facts and circumstances, however, the patient's uninsured, potentially eligible for Medicaid, but not for charity care. So again, based on historical information that you'll have to develop, entities, patients who are pending Medicaid have a 60% probability of qualifying for Medicaid benefits. And again, I know I'm just throwing out these percentages. It's a lot more difficult to get that information out of your systems. But because it can take several months to obtain that determination, what do you do at that point or at the end of the month when you're making that entry? So in this case, 60% of the 10,000 or 6,000 would be deemed pending Medicaid. So that's how you would record that revenue. And then assuming you have a 45% Medicaid discount, I know it's probably larger, but just assume, you would have 6,000 of revenue and a related contractual adjustment offset of 2,700. So that portion, that 60%, would be recorded very similar to the pre-606 concepts of revenue that we currently have. The remaining 40% of the 10,000 or 4,000 would be evaluated just like an uninsured patient that we saw in example 1. So if we assume the same kind of facts and circumstances using a 10% collection rate, only revenue of $400 would be recorded. So the other $3,600 would be that implicit price concession, which was the $9,000 in the first example. So you have total revenue recorded as $6,400 with a Medicaid discount of $2,700, or revenue of $10,000, implicit price concession of $3,600, and then the discount of $2,700. So a couple of key points with this one. Obviously, computer information systems need to be able to provide this information, or you need to be able to query the system. And I was just working with a client last week that is using an Epic system that drops it into a kind of a report generator using a zero balance methodology, and has been able to, not the first time, it took her a couple attempts to get through it, but has been able to query the system and get some of this information out of the system. So as I said, the adjustments necessary would likely be posted monthly rather than on a daily basis. And this is complicated. And part of the thing, if you really think about it, other than example 3. Example 1, you know, before, if you knew you only had a 10% collection rate, you were just recording provision for bad debt of $9,000. So some of it is geography. It's where that's going to be located, since the provision for bad debt is going down to an operating expense rather than a deduction from revenue offset. So in the end, in a perfect world, assuming all things are, you're getting the information you currently need, your end result of this should not come up with materially different results than what you had before. However, what we have been seeing in practice is that many clients were not querying their systems, digging into it as much as possible, using a lot more of the this bucket is 5%, 10%, 15, what have you, kind of truing it up at the end. So in those cases where maybe the models weren't as sophisticated or were not really doing as good of a look back to see how close and revising those estimates, then this potentially could have some impact to what is being recorded in the bottom line. So that's kind of what this next slide is talking about. Is it an implicit price concession or bad debt? Some of it obviously involves a level of judgment, but the kind of the key to this, and it's contained within the guidance, is you should be sophisticated enough in your estimates of the implicit price concession throughout the time that at the end, when claims are ultimately resolved, you're not going to have significant differences between what you estimated and what really happened. So it puts a little pressure on healthcare entities and the auditors to make sure that that's indeed what's happening. So one of the things I'd kind of talked about in the discussion on the historical information, the guidance contained in Topic 606 is such that contracts should be evaluated individually. I would say for many healthcare organizations, trying to look at each encounter with each patient individually obviously is a lot of work and probably not feasible. So there is a practical expedient that allows the guidance to be applied in a portfolio approach to contracts of similar characteristics. And again, this is the bold piece that's very important. If the impact of applying the guidance to the portfolio would not differ materially from applying the guidance to individual contracts. So a big piece of adopting Topic 606 is really going to be the identification of those portfolios. If you think of what your accounts receivable or even your revenue kind of looks like right now, a lot of it's done by payer. So you're going to have Medicare, Medicaid, commercial insurances. If you have a couple of larger commercial insurances in your area, you may have identified Blue Cross or Medica or what have you. You might have workers' comp, or some of those. Self-pay will be a big one. Oftentimes, especially within the self-pay category, another one would be commercial insurances where you have multiple types of plans. So you have more of a standard insurance versus a high deductible health plan, say with the Blue Cross Blue Shield plan. Those are going to likely have different collections. Self-pay will have different collections, whether hospital or clinic, inpatient, outpatient. Oftentimes, you know, what we see historically is that a large inpatient claim is less likely to be collected than on a self-pay basis than maybe a smaller clinic, depending on, you know, your area as well, the types of patients you have, you know, maybe, you know, a major business went out of business, you know, things can change. So it really is understanding your receivables, your revenue, and kind of trying to figure out homogeneous groups within that, especially with the self-pay. That's where the biggest part of this is going to be. So likely some type of portfolio approach will be adopted, and actually one of the white papers that was issued by the expert panel for healthcare does talk quite a bit about this portfolio approach, anticipating that many healthcare organizations, especially hospitals, will adopt that. So as I said, some possible characteristics, which I just kind of went through: inpatient, outpatient, you have skilled nursing, home health, maybe type of payer, type of patient responsibility. Some of them I have seen by payer, then within the payer would be inpatient, outpatient, you know, clinic, what have you. So generally, the current methodology of splitting revenue and receivables by payer likely will not be detailed enough to be considered a portfolio under this guidance. There could be some areas in some states where maybe the Medicaid plan is very similar. There's really only one to choose from. You know, maybe that one you could get there, depending on how detailed out your commercial insurances are. Maybe some of those individual commercial insurances you could get to, that's a portfolio, simply because the contracts contained within that are very similar. So it really is coming down to how does this look, and that's right now with the clients that are going through this process. It's trying to figure out what makes the best sense for a portfolio. You also don't want it to get so cumbersome that you simply can't manage it on a monthly basis. You still need to get financial statements out timely. So you're going to need to work with, you know, possibly your software vendor, possibly your business office, and as I said, kind of the experience we've had, you know, there's good people working in those business offices. It really is coming down to making sure you're speaking the same language, because they approach it from a different concept. They're looking at actual collections rather than trying to look into the future in the crystal ball and figure out what will we expect to get. So you have to kind of get over that language hurdle, if you will. So identification, step 2, now we're back to those 5 steps. We went through the 5 criteria under step 1, now we're in step 2, identify the performance obligation. Oftentimes, the entire bundle, we're kind of used to bundles within the healthcare industry. It's a bundle of goods or services that is distinct. So in the examples we went through, 1 through 3, really that entire emergency department visit is going to be considered the performance obligation. So you're not going to recognize revenue as this medication is delivered or as the physician provides this service within the emergency room. It's going to be the entire bundle. There could be examples within the healthcare industry, however, though, that you would have multiple performance obligations. One of them that I've thought of is potentially with home health, where you have that episode of care. You know, when you're going to recognize that revenue as services are provided, because that episode of care is going to cover a longer period of time. So, and the importance of identifying the performance obligation is that you don't recognize revenue until the performance obligation has been satisfied. So in those areas where you do have more than one performance obligation, i.e. such as home health and episodes of care, you would then be able to recognize as each individual performance obligation is satisfied. And the definition of performance obligation would be one of those additional disclosures that would be required to let the reader of the financial statement know kind of what your organization is identifying as those performance obligations. The transaction price, we kind of talked about this. You know, we have the standard pricing within the charge master, and again, this may not be the actual consideration an entity expects, which is that portfolio concept we discussed just a moment ago. So the transaction price and what you record for revenue may or may not, and likely in many cases would not be what you end up recording. We also, there's different contracts, different payment terms, and so, you know, sometimes it can be difficult. Usually your charge master will get you what you need, though. Obviously, when identifying the portfolios is a key piece of this. You will need to exercise judgment, and you will need to continually modify and refine that. As I said, if you're in a smaller community and a major employer moves out of the community, so you have more people, either with, you know, COBRA high deductibles or things like that, you know, the landscape changed, and so you'd have to factor that into what you're looking at. Because again, the big key to this and what will be looked at during your audit is and we always do a retrospective review, so it would be how close were you? So with what you estimated to where you ultimately ended up, you know, were they close enough, or do your portfolios need to be revised because you have too many outliers, if you want to use that terminology, contained within that portfolio? Okay. Keeping another idea in mind, the portfolio approach is a practical expedient, does not need to be applied across the board. So if you are, for example, a critical access hospital and, you know, you don't have a lot of large claims, but maybe you have a swing bed patient that's been there for a while, you know, maybe you can set a threshold and say, we're going to do a portfolio approach. However, if a individual patient's services exceed X dollars, we're going to look at that on a contract by contract basis. You could do it in a PPS hospital too if you have a very large claim, and look at that individually. So you don't have to do it across the board, but that would be something that would need to be discussed and determined what you're going to identify as kind of that high dollar threshold, if that's something that you're looking to do. Okay. So another key point, and this is something that making sure the business office understands as well, oftentimes you'll be reporting an amount less than the standard or billed rate, even though you are going to try to attempt to collect the entire amount, less any contractual arrangements you have with your third-party payers. So this is just from a logistics standpoint on what you're seeing, what the business office is seeing versus what's being reported in the financial statements. It could be very confusing, so it's making sure that that communication is happening, and again, this key concept of that would not result in significant revenue reversal or changes. You have to try to get as close as you can. Allocate the transaction price. This is the one where I said with an episode of care, you may have to allocate, if your episode of care is X number of RN visits, X number of aid visits, you know, whatever those services are, try to allocate that entire price to the various areas so you can record that revenue as those visits or what have you occur. So we get to the end, step 5, recognize revenue when the performance obligation is satisfied. So that's the ultimate goal of the steps 1 through 5, is get to the point where you can recognize revenue. Some of the accounting scandals, if you will, not so much in the healthcare industry, the accounting scandals tend to revolve around estimates with their party payers on the cost report, also a little bit with, you know, is it an asset, is it not an asset, should be expensed. But in some industries, revenue recognition becomes a key part that is looked at, especially during audit time. And not to say that it isn't in a healthcare industry, it's just the experience has been that a lot of the things that are done that aren't appropriate have a lot more to do with estimates contained within the third party than with actual, you know, we have a patient in the facility and these services were provided. So again, there could be some changes in that, however, because that implicit price concession that's being recorded is a very significant estimate and could be more or less subjective depending on, you know, how it's being looked at and what kind of records are being kept and what type of historical information you have. So quickly going through some disclosures, and this is certainly not an all-encompassing list. One thing, if you're a publicly traded company, SEC, there are more disclosures than if you're not. Many healthcare organizations, at least in this part, probably are not SEC, so some of these disclosures may or may not be required. But you really have to disclose sufficient information to enable the user to understand nature, timing, uncertainty of revenue, and part of that would be with those estimates, making sure they're understanding the implicit price concession, when bad debt is recorded, kind of your contractual arrangements with your third-party payers, which is already in there. There's both qualitative and quantitative information that has to be disclosed. We're going to be still doing that disaggregation of revenues, such as revenue by payer, whether that's a percentage or dollar amount. Significant judgments and changes in judgment. So this is going to be a little bit more, right now we see it with estimated third-party payer settlements. If you had some estimates that the cost report for that year was settled and maybe you'd recorded X and it turned out to be Y, the difference between X and Y, if its material is disclosed, that would be the same even with the information on the implicit price concession. So if something changed and you had to change that estimate because of that change in, you know, whether it's the major employer or what have you, that also would have to be disclosed. Again, that's going to be some of that qualitative information. The disclosures are likely going to use terminology from the standard, which talks about, you know, what the healthcare entity expects to be entitled in exchange for providing care. So that is, again, that language contained within the guidance itself is very important to be looking at, because that is what is going to be disclosed. So it's important to make sure your board members are familiar with that type of language and how it's different than the existing guidance. The definition of a performance obligation, especially if you do have some revenue that's based on episodic care, so that the reader of the financial statement understands that you will be recognizing some of that as the services are provided and not all as one lump sum. Disclosure of agreements with third-party payers, similar to what we currently have. The application of the portfolio approach by grouping patients with similar characteristics. And some of it may be as almost simple as that sentence right there, but it's getting the reader of the financial statement to understand that you are using a portfolio approach, or if you're using portfolio approach, however, using specific contract identification for balances greater than 100,000 or whatever that magic number is. So all of that would need to be disclosed as well. As I said, there was an ASU 2015, so it was issued a year later, that delayed the effective date. I think some people are still hoping that maybe the effective date would be delayed even more. However, those revenue recognition task forces, the RRTFs, have gotten a lot of work done, and I think it's really believed that the additional guidance, the white papers that are out there, auditors, accountants, everybody's getting much more familiar working toward it, so that there isn't going to be another delay. It's kind of one of those things at this point, since the original guidance has been out there for 4 years or nearly 4 years, that it's time to do this. So the effective date for public business entities, certain nonprofit entities, i.e. those with conduit debt. So if your debt, if you have bonds outstanding that have CUSIPs that are publicly traded on some market, you would be required to adopt for reporting periods beginning after December 15th, 2017. So calendar year 18 would be the first to implement. Also keeping in mind, with some of the conduit debt obligors that are out there, you do have quarterly reporting that needs to be done. So that means you can't wait till December 31st, 2018 to adopt. You need to have that reflected in your first quarter of the year. So all other entities, the annual periods are beginning 2019 is the first to implement. So if you're not a December year end, you get a little extra time. So I have a couple of 930 clients who do have some delay before they have to adopt, and they'll be able to see, maybe where the successes and pitfalls, best practices with the other clients that adopt earlier, how that went. So what are the next steps? The provisions of this ASU 2014-09, 2015-14 with the delay will be applicable sooner than you think. It is very important that these discussions start happening with the business office, within the accounting department, so that you can make sure with your potentially software vendor, making sure you're going to be able to get that information you need on collection rates and that type of thing. So certain information needs to be available. Need to start gathering that information now to determine portfolios. My guess would be your first crack at coming up with the portfolios will not ultimately end up being what it looks like at the end. Again, depending on the types of patients you have, you may have a more homogeneous population than the person down the street, but you want to make sure you have enough breakdown, enough detail within that you're going to be able to conclude you would have come up with the same answer, or you came up with the same answer as an estimate that you would at the end when everything's resolved. But you also don't want to make it so overwhelming as far as the number of portfolios you have that it becomes a non-manageable situation. So really coming down to break into portfolios with similar characteristics, that's the key. Once that initial determination is identified, you need to continue to obtain data, because obviously the more things change, the more they stay the same, or vice versa. So you need to make sure that those portfolio definitions haven't changed, and that you're ending up with a group that's maybe too large, so it's going to have outliers on either side and that type of thing. Also, we'll need to be aware of changes in various reimbursement methodologies and change portfolios as necessary. As I said, major employer leaves the community. You're going to have fewer people on Blue Cross or whatever commercial insurance they maybe had, more people, whether they jump onto an exchange or who knows where that's going, or maybe they're now self-pay, and so you have, you know, more self-pay patients, and maybe you'll have to carve out more portfolios depending on how that's going, because they're not going to be as homogeneous as they used to be. So it's very important to continue to educate yourself and your staff on revenue recognition. Here is that link to the revenue recognition RRTF healthcare. That's the Revenue Recognition Task Force, so that's where those white papers are being issued. Talk to your auditors early about the application of the revenue recognition standard. You don't want to be, you know, trying to issue your audit report in whichever year that is coming out when it's applicable to you and the auditor is questioning whether you really had defined your portfolios correctly and is it coming up with what you expected. Also, educate your board of directors, because there's additional disclosures that are coming in, and make sure they're understanding what that is, and the accounting treatment will change again. For those board members that have maybe been on hospital boards for a number of years, they'll probably groan pretty loudly at the provision for bad debt going back down to an operating expense, but it's very important that they understand what the implicit price concession is. So what used to be the provision for bad debt, if you think about it, really is being split into the implicit price concession, what you just didn't really expect to collect, and then bad debt, which would be arriving from the old HFMA standard 20, the inability to pay implicit price concession versus the unwillingness to pay the bad debt. So that's part of the reason it's moving down to an operating expense. Okay. We are 2 minutes late. Was going to try to keep about 15 minutes for any questions, but would certainly be willing to try to answer them or discuss any of the kind of practical lessons we have learned so far from the clients who have started the process of initially identifying portfolios is where the process is at this point.
That is very good information. Thank you so much, Renee. That is, our audience typically loves really tactical information that they can walk away from this webinar and actually start executing on. So great insight here. There are a few questions that have come in, but I would like to address one question of accessing the slides. So if you missed the intro, you can access the slides right now. You should have a handouts panel floating right on the right side of your screen under where you type in questions. If you expand that, you should see a PDF icon, and you can get those handouts right now, so no need to wait on those. So yeah, like I said, let's see how many of these questions we can tackle. The first one will come from Sean, and it's a multi-part question, and it asks, if you need to record missed estimates as bad debt, how does this work mechanically? Do you need to have multiple allowances for bad debt buckets, one for each portfolio, and the true up of each running as increases or decreases to bad debt expense? And I'm happy to repeat that if I need to.
No, I think hopefully I know where he's going with that. You know, part of that and how you're going to track it, first keeping in mind if you miss the estimate and kind of after the fact realize that, you know, maybe your implicit price concession estimate to begin with was not accurate. So maybe you were using 15%, for example, as your collectability on self-pay patients greater than 10,000. And now you've got additional information, you know what, it really was only 10%. That true up can run through revenue, i.e. the implicit price concession would be increased. So, you know, if before you'd only recorded $8,500 on that $10,000 and then looked at it and said, you know, wait a minute, this really should have been 10%, that additional $500 would not go through bad debt necessarily. You could have it as an adjustment to your implicit price concession as long as your portfolio historical information supports that. The write up, write down of the bad debt piece, you know, whether you track it by portfolio, however you track it, if you track that in the general ledger or do you maintain another schedule, you know, that's somewhat of a a call within your organization as to what makes sense. Again, you don't want to get it too cumbersome that it's impossible to manage and track and remember, oh, I have these 15 bad debt accounts, but at the same time you want it to have the good information. So if you're worried that maybe your portfolio for high deductible health plans under commercial insurer A, you want to make sure what are we ending up writing off on these, because right now I'm not real comfortable that my implicit price concession amount is correct, or do we have to update that, then maybe tracking that somehow, whether it's within the general ledger itself or some other mechanism of tracking that within your software, or within some entities are using, I'd almost call it a hyper Excel type of a situation where they're dumping the information from the billing software into basically a program that allows it to be manipulated, sorted, easier, that type of thing. So there's multiple ways of doing that. I don't know that it has to be within the general ledger, but I can understand what you're trying to get to make sure that your portfolio definition is accurate.
All right, so let's just keep moving along. The next question comes from Mary, and she wants to know, do you have any insights on the magnitude of change in operating margin percentage as bad debt again moves to expenses?
I would say we're pretty early in the adoption. However, for the clients that I'm working with right now on getting the portfolio set up, what I have been happy to see is that their systems were sophisticated enough, and how they were recording kind of their allowances for both contractuals and bad debt in the past were pretty good. There is going, right now that provision for bad debt is up top, and so it's in the total operating revenue, so it's already there. Generally, especially with self-pay buckets, what we're seeing, as long as management's being realistic on what the collection percentage is for that implicit price concession is still staying as that offset to revenue. So it's going to be in your total or your net operating revenue number. So that operating margin, the operating income loss, assuming your systems were identifying it correctly in the past and you're using that information to come up with those estimates, your operating margin may change a bit because you're going to move part of that down to operating expense, so your operating revenue is going to be a little bit higher than what it was before. But what we have kind of seen, or what the expectation is that there's going to be things moving to bad debt, but we just really don't have a great feel. But our initial assessment, because so much of that is being, especially for self-pay, recorded as an implicit price concession, the amount that is ultimately going to end up in bad debt on some of that is not going to be that large as a percentage anyway. But I'm also working with the clients currently that have very sophisticated systems, because they're going to have to be in that early group that adopt. So not quite sure what we're going to really be seeing as we move into maybe some of the computer systems that are maybe less sophisticated, or where the client hasn't yet developed some of those more sophisticated models of determining the allowance for especially doubtful accounts.
All right, thank you so much for those details. Our next question comes from Cindy, and she's wondering if you can shed insight on how this applies to a governmental or county hospital that is subject to GASB as well as FASB standards.
Right. Right now, as I kind of said at the beginning, the GASB is coming out with their own revenue recognition and expense recognition standard. That is right now out in exposure draft, so it still has a while before the process runs through. So if you're subjected to both, right now the FASB would be the only one that has the guidance out there. And the way the GASB kind of works, as long as it's not specific to a nonprofit or contradicts with GASB, then you would use what's out there. I would say my recommendation would be, especially because we have some time, depending on if you're an 18 or 19 adopter, would be to look at that exposure draft and see what are the similarities and what are the differences. And unfortunately, I think it came out late last week. So I have not had a chance to look at that. I will be diving into it. I sit on the GASB part of the expert panel, and we'll be looking at that. So right now, I would say since the exposure draft is out there, make sure you're familiar with what that GASB revenue and expense exposure draft is looking like, to see. Sometimes they borrow from the FASB, sometimes they do the exact opposite of the FASB, and I'm not quite sure where they landed on this.
Perfect, thank you. All right, this question, and I had to verify that it wasn't actually coming from a vendor, but nope, it is a provider who wants to know, in the pilot projects, are you finding the EHR vendors are being proactive in developing functionality to get the reports needed? Do you have any insights there at all?
Well, right now what we're seeing, kind of with the, the EHR / billing collect, whatever that revenue cycle is, I would say with the ones I'm working with currently, what they're really doing is, like I said, they're kind of dumping that information into another product to be able to manipulate it and get some of that information and sort it the way they need to sort it. Not to say that it can't be done within the actual billing software that's currently there, but either they don't know how to, or maybe they do have to work with the software vendor to try to develop some of those. So right now, what we're seeing is, it's kind of an end around. They're dumping it into another software package to try to do the understanding.
All right. Okay, I think we may have time certainly for one more. I will try to squeeze in two, but this next one comes from Tanya. She was wondering, with your example number 3, what if your state doesn't allow you to bill the Medicaid patient? How do you record that $400 that was referenced?
Okay. Well, what that would be then is, if you can't bill Medicaid, then your portfolio for Medicaid would not show a 10% collection. But if that patient is, the reason that $400 was recorded is because we're saying there's only a 60% chance they will be Medicaid eligible. The other 40% means they move into the self-pay bucket, so that $400 that's being recorded is in the self-pay arena, not Medicaid. So that split would still happen as far as recording the $400 worth of revenue, but it could be such a thing that, some states under that Medicare, that 60% chance that they're going to be under Medicaid, where that you already recorded that contractual, you'd need to make sure that kind of that contractual piece includes the fact that you can't bill the patient for anything. But again, that 40% is that the chance of them being not eligible, and it would be self-pay.
Perfect. Okay, I know there were some other unanswered questions. I apologize, and they were really, really good. We can't get to all of them, and I'm very sensitive of everyone's time that has been allotted for this webinar. So as we approach the top of the hour, I do want to take this time to thank our members and the healthcare community for joining this call. As you exit, you will be prompted with a survey, and we would appreciate you sharing your feedback about today's event, as well as some other topics that you'd like to see in future webinars. And on that note, March 20th is the next monthly installment, so keep an eye out for registration details for that one. So thank you again to our guest speaker, Renee of Eide Bailey. Just absolutely fabulous information. I can already project what the survey will reveal. So thank you for taking time to prepare and share this with our audience. On behalf of HFMA Region 8, thanks again for joining. Have a great afternoon, everyone.
Thank you.